This podcast discusses exchange-traded options issued by the Options Clearing Corporation. Options involve risk and are not suitable for all investors. Individuals should not enter into options transactions until they have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options, available by calling 1-888-OPTIONS or by visiting www.888options.com. None of the information in this presentation should be construed as a recommendation to buy or sell a security or to provide investment advice.
Good news for investors this week as the market closed at a 17-week high.
This is OIC's Basic Options Podcast number 2. Option Strategies for Stock Investors, covering options terminology and mechanics.
Now we're going to get into some basic terms and some mechanics of options. Now the theme of tonight really is that trading options requires a totally different way of thinking than you're used to if you're a traditional stock investor. There are a lot of things from being a stock trader that apply, but it's a different philosophy and it's a different thinking process, and I'm going to touch on that a lot during the presentation. First of all, if you buy a stock, you're buying quite literally a share in a company. That's why they call it a share. You're buying a share of ownership, right? Options are appropriately named as well. When you buy an option, you're buying a contract that gives you an option to do something at some point in the future. There are a couple terms, holder and writer. A holder of an option is someone who has bought an option. He has a long position. All these terms are fairly synonymous: holder, buyer, and long. If you buy an option, you're buying a right. If you buy a call option, you're buying the right to buy the underlying stock at a specific price at some point in the future. If you buy a put option, you're buying the right to sell the stock at some point in the future. Now, the put option seems a little counterintuitive. You're buying something, and you want the stock to go down. Now, on the other side of this is the writer, or the seller. Now, both parties of the contract can have rights. One person gets to decide, and the other person incurs an obligation. It's kind of like any other contract. It's kind of like, if you're going to the movies with your wife, and you say, oh, well, you can pick the movie tonight. Well, she can exercise her right to decide what movie you're going to see. And you're obligated to see whatever she picks. But when you sell an option, you incur an obligation. If you sell a call, you incur the obligation to sell the stock. And if you sell a put, you incur the obligation to buy the stock. All right, now I want to go through just a typical option contract. The example here, XYZ, December 45 calls at 5:50. This is pretty typical. The first term is the underlying. Now that's the same as with buying a stock. If you're buying a stock, you pick a particular stock. I pick XYZ stock. In this case, we're talking about an XYZ call. This call gives the holder of the call the right to buy 100 shares of XYZ stock. Now the second term, this is a term that's unique to options. The strike, or the exercise price. In this case, it's 45. The XYZ December 45 calls. Now, if we're talking about an option being the right to buy or sell a security, well, what's important is at what price, right? Because we can already go out and buy the XYZ stock if we want to. So in this case, if we buy this call, we're buying the right to buy 100 shares of XYZ stock at $45 a share. Now the next term, this is unique to options again, the expiration date. All options have a limited life. These calls, these XYZ December 45 calls, expire on the Saturday following the third Friday of December. Now the final term we're going to talk about is kind of similar to trading stocks as well. It's the premium, or the price. When you buy an option, you have to pay for it. If you sell an option short, well, then you receive this premium. Now, we talk about this XYZ option. giving you the rights on 100 shares of XYZ, right? So if we pay $550 for this call, we're actually going to pay $550 because that premium is stated on a per-share basis. These are contracts that give you rights. You don't necessarily have to exercise your rights. Exercising an option is an active endeavor. It's your decision. And the way to remember this is just, you can choose to exercise physically if you'd like to, right? If you exercise a call, you end up buying the stock at the strike price. And if you exercise a put, you end up selling the stock at the strike price. Now, on the other side of this, the person who has sold the option, who has incurred an obligation, well, if the holder of the option exercises his rights, they get called upon to fulfill that obligation. And that's called assignment. Now, assignment, you don't have a choice. If you sold an option and you get assigned, you have to fulfill that obligation. And the way to remember that is, well, it's just kind of like when you're in school and your teacher gives you an assignment. You don't have a choice. You have to do it, right? If you have sold a call and you get assigned, you're required to sell the stock. If you've sold a put and you get assigned, well, then you're required to buy the stock at the strike price. A couple more terms we need to go over that are important. Intrinsic value and time value. Here we have a stock that's trading at $56. The 50 call is trading for $8. Since call options give us the right to buy the stock, if we decided to exercise this call, what would happen? We buy the stock at what? At the strike price, at $50, right? If the stock's trading $56, we can turn around and sell that stock immediately in the open market for an arbitrage $6 profit, correct? This option is bare minimum intrinsically worth $6. No reasonable person will sell us this option for less than $6. This is what's called intrinsic value. It's the difference between the stock price and the strike price. What's left over is referred to as time value. Time value is the total option premium minus the intrinsic value. Whatever's left over is referred to as time value or time premium. Let's look at one more example. Here we have a 60 call trading at $210. What's the intrinsic value of this option? We're using the same stock price. Stock's trading $56. We're talking about the 60 call. What's the intrinsic value? In this case, it's 0. Because think of it this way. This call gives us the right to buy the stock at 60, correct? We don't have to exercise that right. So why would we exercise the right to buy it at 60 if we can buy it at 56? So that option is worth nothing intrinsically. Intrinsic value is always greater or equal to 0. All right? It can never be negative. Okay, so the intrinsic value is 0. What's the time value then? Exactly, $210. It's just what's left over. There are 3 more terms that we have to know. In the money, at the money, and out of the money calls. You've all heard these tossed around before maybe, right? An in the money call is when the stock price is trading above the strike price. It has intrinsic value. The other term, just the opposite, is an out of the money call. An out of the money call is one that has no intrinsic value. Here, the stock price is trading below the strike price. The final term is an at the money call. And an at the money call just simply means that the stock price is trading right at the strike price. Now, this is the textbook definition, but in practice, the stock doesn't have to be literally exactly at the strike price. If a stock is trading at, $71 a share, and we're talking about the 70 calls, those are the at the money calls for all intents and purposes. Now, whenever you buy an option, one of 3 things will happen at some point in the future. It will either be exercised, it will expire, or you'll trade out of it. There are no other choices. And it's very helpful to plan ahead because you know this is going to happen, so you should kind of have in the back of your mind what you think you want to happen of these 3 choices. Now, with options, you can also get short. It's kind of similar in concept to shorting a stock, but a little different. Now, most of you said you've never shorted a stock before. Shorting an option is a very common strategy. As many people sell options as buy options. Now, if you sell an option, one of these 3 things will happen. You'll either get assigned, it'll expire, or you'll close out this position by buying it back. All right, now we have a quiz. All right, everybody take out your number 2 pencils. Keep your eyes on your own papers. Okay, the first one, we have a stock trading at $78. We're talking about the 70 calls that are trading at $10.50. What's the intrinsic value of this option? $8. The remainder is time premium, $2.50. How about for the next one? Stocks trading $36. We have the 35 call valued at $3.75. What's the intrinsic and time value? That's right, $1.0275. All right, one more. Stocks trading at $41. The option's worth, we're talking about the 42.5 calls. They're trading at $1.65. What's the intrinsic value and what's the time value? There we go. 0 and 165. All right. Stock is trading $55. Are the 60 calls in, at, or out of the money? Out. Stock's trading $33. Are the 35 calls in, at, or out? All right. Stock's trading 77. Are the 75 calls in, at, or out? Yep, they're on the money. Those are all the terms and all the basic concepts and mechanics that I have to go over.
Good news for investors this week as the market closed at a 17-week high.
We hope this podcast has helped you better understand basic options terminology. For answers to your options-related questions, please call 1-888-OPTIONS or visit OIC at www.888options.com. The next podcast in the series is OIC's Option Strategies for Stock Investors, podcast number 3, Buying Calls.